Master your money, free your future. Welcome to Budget for Life. My name's Jeremy. I'm not a professional YouTuber. I'm a financial advisor, but this video is not financial advice. In this video, I want to talk about a commonly accepted narrative, which is that the demise of GameStop was simply related to the transition away from physical video games to digital video games, and that GameStop just didn't evolve, and therefore it was doomed. But the truth is, GameStop was artificially, intentionally, purposefully destroyed from the inside out. And I'm going to show it to you in this video. And just off the cuff, if the decline in software was what destroyed this business, then how is this business now with software revenues less than a quarter of what they were back in 2018, 2019? Software revenue less than a quarter of what it was back then, and yet the company is making $1 billion more per year in income, net of SG&A, net of cost of sales than they were then, despite a fraction of the size of the software business. I'm going to show you how GameStop had actually pivoted itself to a profitable company, right? 2015, 16, 17, gross profits growing year over year, over $3 billion of gross profit per year. And then suddenly, somehow, losing hundreds of millions of dollars a year. It was not an accident. I'm going to show it to you in this video. Hopefully, you learned something, and hopefully, you're reminded why so many of us got involved in this GameStop story in the first place, to put an end to absolutely corrupt behaviors from short sellers in Wall Street, like what's illustrated in this video. Before I get into it, thank you to those who have joined the sub club, the Halo sub club. There's 324 spots left, okay, all the way to 2525. We'd love for you to be a part of it. Thank you for all the views, the comments, the engagement, the watch time, and those who join the channel as fans and as friends if you want access to my GameStop spreadsheet. So let's look at the GameStop of old. How were they generating $3 billion of gross profits? And what was their leading line item, right? What was the most profitable portion of their business? Well, the most profitable was digital sales, which is still probably the most profitable, right? When they sell a game or a Xbox Live Pass or whatever digitally, the profit percentage on that for GameStop is high. But look at the technology brands division in GameStop, absolutely crushing year over year. Look at the gross profit in 2015 of 57%, and then to 2016 of 68%, and then to 2017 of 74% profit, right? So on this 800 of revenue that they did in 2017 from their technology brands, 594 of that was profit, right? An insane gross margin. Their total gross margins was 33%. What was the technology brands? This was GameStop being smart, recognizing the coming transition in the video game industry, right? Where physical software is less of a dominant player, and also recognizing that their position as a retailer was all in on the video game basket. And you know what they did? They said it would be great if we could sell some other products, if we could have some other stores. So what was their technology brands? It was the largest AT&T dealer in the world, right? Including not only AT&T products, iPhones, etc., but also DirecTV as well. And it was Simply Mac, the largest Apple authorized retailer at the time, right? What better two partnerships, two companies to open stores as than AT&T and T and Apple, right? Companies that are worth AT&T $185 billion, Apple today worth $4 trillion. Amazing job by GameStop's legacy leadership to recognize this shift in the video game industry and to decide to open thousands and thousands of alternative retail stores that still have some synergies some overlap in customer base to the traditional GameStop customer. So what did GameStop decide to do, right? When you see a portion of your business that is struggling, is declining, right? Look at new video game software year over year from 690 to 600 to 590 in gross profit. Look at the pre-owned business year over year from 1.1 to 1.0 to zero point 0.9, right? Video game accessories flat, digital growing a little bit, right? Growing a little bit. Collectibles doing great. And we see the GameStop of today has only doubled and quadrupled down on the collectibles business. But why can't the GameStop leadership of today continue to scale and grow the highest gross margin, meaningful driver of gross profit for their business, right? Even collectibles, right? The technology brands did 3 times as much in gross profit than the collectibles business did, right? Even digital, right, which had a slightly higher gross profit percentage, right? The tech brands did almost 4 times as much in gross profit. And all of these gross profits, new hardware, at best case, you could say is cyclical. And then new software and pre-owned software, without a doubt, was declining year over year. But the transition point was there and was actually scaling fast enough to more than usurp the declines in software, right? The total gross margins were actually increasing year over year on a dollar basis, right? 2.9 to 3.01 to 3.04. So anyone rationally that's leading this company would say, let's continue to operate, scale, grow our AT&T stores. But what does GameStop decide to do? Let's look at the story, okay? So in February of 2018, right before this is produced, right? This full year fiscal 2017, right before these numbers come out, it's very clear, and you'll see the story that GameStop, it did not die organically, but it was killed. Okay, so what happens first? Great, let's get a new leader for the company. Let's give cash dividends, right? Let's continue to not only give cash dividends, but let's continue to grow our cash dividend level, right? So let's give money away despite what? Despite net income going from 353 million in 2016 to 34 million in 2017, right? So we are going to have a net income that is 90% lower, but we're going to increase our dividend. Absolutely insane. And by the way, why is net income that much lower? Because we just showed you, right, the gross profit was actually higher. How did they manufacture a net income that low? Well, guess what? It was manufactured. It was all goodwill impairments and asset impairments. For a company that averaged what, about 10 to 15 billion or million dollars per year in impairments, they decide in 2017 to recognize almost $400 million of impairments of a non-cash impact to net income to artificially deflate their net income and to begin the demise of their stock. Look at this. Why did they decide to recognize that impairment? Well, because of changes in AT&T's dealer agreements, resulting in the declined projected profitability in long-term forecasts. I'm sorry, but the numbers say that your profitability is skyrocketing, right? From 57% to 74% in just 2 years, right? And if you've owned these stores since back when they were 57, even if you projected a decline from 74, if you purchased these stores even before they were even in the ballpark of 74, then your goodwill cost basis, your asset cost basis, the way you value these businesses should still have more than enough um, support, right? But they say, no, we're just going to recognize by our own choosing almost $400 million of damage to our assets to report a net income 90% lower than what people are used to. And then we're still going to increase our dividend. What happens after that, right? Mr. Mahler says, right? So the interim CEO, he says, hey, we had a solid 2017. Moving forward, we're going to pause investing in new businesses or acquisitions. We're going to focus on improving the fundamentals of the businesses we already have. That could mean good things if he's including tech brands, right? If he's going to continue to grow this business that they already have, that would make sense. But what he's really saying is we're not going to grow anything. We're not getting any new stores, and that includes tech brands. And that is insane. The second thing that's insane is he's saying we're going to focus on improving this business. What he should say is we are going to downsize our footprint in the video game space, and we're going to continue increasing our footprint in the tech brand space. Look at this whole 10K, all 53 times, okay? They talk about our video game brands, our video game brands. What's GameStop's video game brands? You know what their video game brands are? GameStop. That's GameStop stores. GameStop back in 2017 was so far along their diversification process that they differentiated video game brands, aka GameStop stores, from technology brands, right? They had over 1,300 stores that were not GameStop stores. You understand? Surely you understand. But he says, instead of closing down the stores that are starting to struggle, instead of shifting away from software, we're just going to try to do better. Okay, thanks. What happens next? Oh, he resigns. Oh, cool. So, why did he resign? Personal reasons, effective immediately. So, 2 months later, right in May 2018, he says, I am out. Why was he out? Maybe as a longtime GameStop employee, Mahler said, I can't do this. I can't stomach being a part of destroying this company, right? This intentional destruction of value, intentional missteps in leadership for the benefit of short sellers. I can't do it. I'm out, and I don't want to say anything else about it. No worries. 1 month later, look at this. GameStop is exploring discussions regarding a potential transaction. We're not going to say anything else about it. Okay, so literally 1 month after this guy resigns for personal reasons, this news release comes out that, hey, GameStop's looking to sell some portion or all of its business. So Mahler obviously did not want to be a part of this and did not feel like this was in the best interest of GameStop. At least that's how I would read it. What happens? Oh, 2 months later, you know what we can do? Let's hire expensive board members. You know what we need? We don't need to cut costs. We don't need to close some of our video game stores. We don't need to expand our tech segment, right? What we need to do is hire more expensive board members, right? This is key. This is classic for any business that's being artificially suppressed, that's being destroyed, rotten from the inside out by people with no souls. Just kidding. They probably have souls, but obviously, not a decision that's in the best interest of the company. Another thing they can do is they just start spending their money, right? Let's give away dividends and let's hire more board members. We need more leaders, right? And then check this out. Just a couple months later, 1 month later, still, tech brands' operating earnings are increasing, right? Despite GameStop trying to remove them from the picture, to refuse to invest further in them, they're still continuing to increase profitability. Meanwhile, GameStop, the video game store, is continuing to struggle. But look what they say. GameStop's reiterating its previously issued annual guidance, and it's still going to pay dividends. So look, we're still going to make $3 or maybe $3.35 a share. Everything's good. Don't even worry about it. Classic. Don't worry about it. Everything's good. Because how could it not be good? Because look, 1 month later, we're going to hire 15,000 associates. We are going to hire 15,000 part-time workers. And you know what else? We're going to pay you an extra bonus to say thanks for working at our stores. Did GameStop have to do this? Right? They have 3,800 stores. This doesn't even include their tech stores, right? Just for their 3,800 GameStop stores, they're going to hire 15,000 more people than they already have. And they're going to pay them a bonus, AKA spend the money, wipe the bank account. Let's drain this company for all it's worth. But what are we going to do about this tech brands? What are we going to do about it? Because it's making so much money and it's growing quickly and it's so stinking profitable. How can we tank this company fast enough to um, overcome the growth and the genius that we already had in expanding into AT&T stores and um, Apple adjacent stores? Well, we're going to keep spending money and we're going to sell it. We're going to sell our tech brands. We're going to get rid of this line item. The best thing about our business, we're going to sell. Well, hey, what would it be worth, right? A company with gross profits that have doubled in just 2 years' time from 300 to 600 million in annualized gross profits, right? What type of valuation would that company potentially have? Oh, how about $700 million? Oh, one times gross profit. That's what we can get for the best, most profitable, fastest growing, most important part of our entire business at this point. The pivot that saved GameStop from the software decline. No, we're just going to get rid of it and we're going to take $700 million. And why are we going to do this? Well, we're doing a comprehensive review and we decided that it's best. Okay. We decided that it's best. What are we going to do with the money? We don't even know, but we need to get this off of our books because it's actually doing good and it doesn't fit the story that we're trying to paint to people. Okay. What are we going to do with the money? Oh, I don't know. Maybe pay off some debt. Or hey, maybe we'll buy some shares. Maybe we'll even invest further in the video game business. Maybe we will try to scale the declining business as if our capital investment is the reason why physical video games aren't selling as much. Absolutely insane. You know what else we might do? We just might continue to give more dividends, right? And look at this. Tech brands still increasing year over year and increasing faster year over year. So, yeah, we got to get this off the books. And but hey, no worries, right? This is November of 2018, right? So fiscal 2018 is already um, close to a close at the time of this release. They have 2 months left in fiscal 2018. And look what they're saying about their earnings. Hey, it's all good, right? A little lower. But hey, Tech Brands is growing, but hey, we just sold that, so don't worry about that. But hey, even still, once you net out the impact of the Tech Brand sale, we're still going to make 250 to 275 per share in earnings in 2018. How did that age 2 months later? They made negative $700 million in 2018, right? Do you think this was a genuine projection, right? Or do you think this is leadership that doesn't have the investors or the company's best interest in mind, saying, don't even worry about it, just listen to this elevator music? Because if we told you how bad it's going to be, there's a chance you would try to take over this business. There's a chance you would try to remove us from leadership and resurrect this business. And so we don't want you thinking things are going bad. We have to help you think that things are going good. And we're just going to straight up lie to you about guidance that's orders of magnitude off from reality. Then what happens? Hey, guess what? Another dividend. And you know what? We're going to buy back $300 million worth of shares. What are we going to do with this 700 million that we should have gotten several billion dollars for, right? The sale of this tech brand. We're just going to dump it all into buying our own stock. In March 2019, March of 2019. Hmm. Yeah, at $3 per share, when everything that's left in the business is officially declining, other than digital and accessories and collectibles, which are somehow treading water, but not nearly enough to backpack all of the storefront devoted to the software portion, right? They know this business is declining. They're saying, let's dump into shares now. And guess what? All of that cash is going to evaporate when our shares are down another 60% from that purchase price, right? The easiest way to evaporate capital, if you're artificially trying to destroy a company, is to buy shares when they are overvalued and then to sell shares when they're undervalued, right? It's literally poofing cash away. What else can we do? Let's hire another expensive CEO, right? We had that interim CEO who was doing his best to destroy the company, but we need a professional, even more expensive CEO to really destroy the company. What does he say? Very excited. I'm honored to have the opportunity. Listen to what he says. I bring significant experience working with other retailers that have undergone large, successful transformations. Okay, so before this post in March 2019, all they were saying in 2018 is everything's good. Everything's good. Everything's good. We're on track. We're going to be profitable, right? All good. Then the numbers come out. And what does GameStop do to avoid an outside entity trying to take over the company? Finally, they have to acknowledge that the numbers aren't going well. And so they have to say, hey, turns out we were way off in our estimates, right? Things are going horribly. But look, we have this guy, and he says he's great at transformations. So y'all think we need to transform? Okay, we were saying we're good. Now it looks like we need to transform. Well, now we're going to transform. Okay, ridiculous. What are we going to do to transform? Oh, let's hire some more new board members, spend some even more money. Oh, what do we need to do? Oh, let's get some more new people in the board. We need more people to suck up the last bit of cash that this company has, right? 2019. Look how fast they spent all of this money, right? They raised $700 million, which was a gross undersell, you know, should have raised way more. And they spent it all and then some in less than a year's time. Just absolutely gross. And why are they spending it so fast? Because it's an artificial destruction of a company and because they have to do it fast enough before the console cycle comes. Okay, because they're trying to get this company dead in the water before the new Xbox and new PlayStation come out. So let's spend the money. Let's spend the money. Oh, here we go. Let's buy some more shares, right? Check it out. A purchase price of 520 per share. How did you even time that out? You probably bought these at the most expensive point you possibly could have bought them. 2019, July of 2019? Are you kidding me? They were $1 a share, and you went and bought your shares for $5 a share. That's an 80% evaporation of cash off the jump. Here comes holiday sales. Turns out things aren't going well, says George Sherman. But don't worry, even though things haven't gone well so far, we've got everything in place for our long-term action plans. Your long-term action plans to destroy the company, Mr. Sherman. Isn't this crazy? Hey, we're all good. We're all good. And then look what happens, right? More and more fights over. the leadership of the company. And look how, let me pull it up. Look how active GameStop was um, once the fight for their company really began. So after these annual numbers for 2019 comes out, and it's just that much more obvious, right? They're blowing all their cash. They're trying to destroy the company. Um, Hestia comes out and is trying to take over, right? And so GameStop's like, look, don't vote for these propositions. Look at everything we're doing that's so good. We're delivering results to shareholders. Yeah, results that are trash, trash, city trash. But look what else we've done, right? We've launched a plan. We've launched a plan. We've decreased inventory. So we sold out our inventory to make our stores look half empty so that people think we're already bankrupt before we're even bankrupt yet. That's what they did. Look at this. Absolutely crazy. And then, so April 28th, they post this, which normally they only post like random stuff about their business, right? Promotional activities. But as soon as they boom, let's appoint some more board members. I didn't even show this one. Did I? Oh, great. Even more new board members. Holy smokes. Just shameless. Then they say after the 28th, again, they're like, look, don't vote for this. Don't take over the company. Let us finish the kill. We're so close. Look, here we are again, 1 week later. Look at our transformations. We've done so much transformation. You know what we've done? We, what did we do? Oh, we finally got rid of the dividend. Oh my gosh. They waited until 2019. You had to let us see this negative 700 million before you're like, after another negative 500 million, you're like, maybe we should stop paying a dividend. That's the best thing you got. Look at this. No, look, there's more. Another week later. Look, we're doing so much great things. We have a newly refreshed board. We got 9 out of 10 independent directors. We got independent, right? We've got all these people that don't have anything to do with our company, right? They're not long-term members of our company. We're just hiring outsiders to come take a paycheck, right? And look, on the same day, look even more, dear, please, shareholders, please look at our amazing board. Just pleading, again, pleading, don't do it, right? Just, and then finally they share the results of a few days later. Shameless destruction of a company. By the way, what's happened with Spring Mobile since then? Oh, I don't know. Look at all those dots. Looks like they're doing okay, right? Looks like they're doing okay. Wouldn't it be nice if GameStop still had a growing 500, $600 million of gross profit on their business? And look in 2018, 2019. Right? If they had that on the books and then continued to scale down, the legacy leadership of GameStop was in place to lead GameStop through the transformation that ultimately Ryan Cohen swept in and decided himself to take GameStop through. But he had to do it in such a worse position with far much less cash to deal with a way overinflated compensation structure for all these corporate executives that he's got to pay off and fire, right? All these stores that should have been closing earlier that he has to then close with the most profitable, most impactful portion of the business no longer accessible, right? Just sold for pennies on the dollar. Just insane how poor these decisions were and how obviously poor they were even at the time, and how the communication from the company was just there to like pacify investors to avoid ultimately what Ryan Cohen did, which is to force a leadership change before the imminent bankruptcy, the imminent killing off of GameStop could be completed. And even with the much worse company, the shell of the company that was left that Ryan Cohen took over, because the destruction work was potent. Potent. I mean, even all these things they say about all the things they've done to help are really just more reasons, more things they've done that have hurt, right? And yet, here we are, 4 or 5 years later, 6 years later, pumping out hundreds of millions of dollars in net income per quarter. An amazing transformation, but I think undoubtedly a very intentional attempt at destruction, not something that just suddenly happened overnight, right? Even in these years of software declines, right? 46% of 8.2 billion is what? 3.7 billion in software in 2018. 3.7 billion. Where'd I go? Here we are. Another 2.7 billion the year after that, 2.5 billion the year after that. These are 30% plus type margins, okay, on new plus used software. Today, the software business is on pace to do 750 million, a fraction of what it was, and yet the company is doing basically over $1 billion. I mean, literally over $1 billion more in net income now than they were then, when they had all of this money from software then that they don't have now. Absolute crazy. The difference in leadership from a leader that actually is trying to lead a company versus leadership that's intentionally trying to destroy a company. Turns out, whoo, it does not take long to destroy a company. Look what the market cap did overnight, right? In these 2 years of utter destruction, right? Compared to in 2017 or beginning of 2016, right? They were at about $6 a share. Not impressive, but in position to overcome the software decline. And instead, that $6 is just turned into pennies on the dollar just 2 years later and 3 years later, before Ryan Cohen comes in, obviously. And then all bets are off. The transformation was inevitable. All right. Hopefully, y'all learned something in this video. If you did, if you have any other thoughts, we'd love to hear them in the comments. Thankfully, we don't have to deal with this leadership team anymore. But man, I wish GameStop still had those tech brands. Wouldn't it be awesome? Wouldn't it be awesome to have 1,000 GameStop stores and maybe 100 Apple adjacent stores and then maybe 1,000 AT&T stores? High margins, man. 74%. Holy smokes. And look at this. GameStop's gross profit percentage, even without that 74% profit on tech, even without that, prior to the most recent console refresh, they were at almost a 35% margin. Just incredible. Okay, I need to stop talking about this because if I think about it too long, I get angry, so angry at the obvious, not ineptitude, not idiocy, but obvious intentional destruction of value. It harms employees, it harms the retail investors that are left holding the bag, and it enriches the pockets of the corporate executives, the consultants, the short sellers, Wall Street that's tipping off, which by the way, who was the broker that facilitated the sale of Spring Mobile to Prime? JP Morgan, okay? Who was, anyways, it enriches the rich and it takes from the common person. It's not idiocy, it's intentional. And it's time for a reckoning. That's all I have for y'all today. I will see you in the next one.